But anyway, even if it doesn't work, we'll be fine. I can present quite well like that. So maybe let me just start saying multilateral development banks, and Avinash, maybe you correct me if you think I'm wrong. I mean, multilateral development banks are, of course, primarily banks, but they also have important functions beyond that. And I'm a public finance person. For me, this is always like, what is the role of the state? And and for me, multilateral development banks have an important function in this development world to strengthen the quality of service provision of the members, the quality of the governments in our members, and at the same time provide financing that that allows to provide infrastructure. In our case, we are an infrastructure bank, and in the other multilateral development banks, also many other things. So in a way, MDBs have a very important multiple function. Uh, we have not we have not succeeded in eradicating poverty in the world, but I think we are contributing in important ways. And in that role to strengthen governments, we are providing, I think, a particularly important role, and that is strengthen governance, meaning the standards with which we apply and implement our projects, and which, so to speak, become a benchmark also for governments uh, uh, to 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 kind of provide quality projects with. And then leading that over to the topic, there's another dimension to this, and that is global public goods. Multilateral development banks are one type of agency that can actually transcend the national interest of its members and kind of in a cumulative sense contribute to the solution of global problems and provide global public goods. And of course, for our times, the most important one, I think, would have unequivocally said, most important one is climate and climate protection. Now, maybe also one could add the protection of international rules, standards, and governance, which has gotten more prominence in recent times. But this forum is about the climate side of things. And if you go to the slides two further on balanced multilateral governance, um, two slides further, you can see AIIB is, AIIB is a new kid on the block. We are only 10 years old. And this has given us the chance to be a little bit different to our partner multilateral development banks, but also copy many of the features of these banks, including from the Inter-American Development Bank, which is also a regional bank, and which is known to be a pioneer on many good things. Of course, we as Asian Infrastructure Investment Bank have Asian shareholders and an Asia focus in our articles of agreement. And but 75% of our shares are Asian and 25% are what we call non-regional. Regional is Asia and Oceania, includes Turkey, includes Russia. And then non-regional are mainly our African, Latin American, and European members. But and even though we are by members, the second largest multilateral development bank, we have 111 members. We are in no way attempting to copy the World Bank or anything. It's just that our non-Asian members are kind of most of the countries that have a strong Asia connection through trade, through proximity, and of course also through global public goods, because the climate problem is not solved in Asia alone. So I'm just asking, I still see the first slide. Is it possible to move to two slides further? Maybe if that was possible. I don't see it moving. I can't do it. well, let's see how it goes. So, as I said, the Asian Infrastructure Investment Bank is an infrastructure bank. But climate finance is, of course, to a significant extent on infrastructure, especially in the renewable energy sphere, but also in some of the transport areas where it's either directly or indirectly, in connectivity, in various aspects. We have various parts of our work. We have climate dimensions. Just maybe on the AIIB to say also, um, we are we have 75% of our shares with emerging and developing members. And that's maybe also a bit of a bit differently from most other multilateral development banks. The Europeans have, and the other developed countries have about almost 30%. And we have a 75% decision-making rule for the most important decisions. So this creates a checks and balance in the system where no group can really dominate the bank, and but any group of the groups emerging, China, Europeans, can prevent the organization drifting off course. And the result is that most of our decisions are made by consensus, if not unanimity. And that I think is really is really important. Um, all members know, in this bank, you cannot win by being divisive. You can only win by, so to speak, trying to help find a consensus. Then that means, of course, you have to make compromises. But if so to speak, it goes in the right direction, then I think that works. And our bank is collaborating strongly with World Bank, Asian Development Bank, African Development Bank, EBRD, um, IADB. I think we have done a few things, but not so much. There we are still quite far away. But when you look at our thematic priorities, green infrastructure is our first thematic pillar, and then private capital mobilization is our second main thematic pillar. And then we have two other ones, connectivity and regional cooperation, and tech-enabled infrastructure. And for green infrastructure, we have a target of at least 50% climate green financing since 2000 and so 50% target since the beginning, and now since recently of over 50% going forward. And last year we reached over 70%. Over 70% of our financing was on climate. And that is I don't know whether it's the biggest share in the MDBs, but it's certainly a very high one. And in our bank, there is no kind of moving away from the climate agenda. We also have a commitment. Yes, thank you. And maybe now move to slide 7. Yes, that one. That one. Great. So we have also the requirement to be Paris aligned. We have issued our first climate adaptation bond, and we have issued our first ISSB aligned sustainability report. We have a climate action plan, or to which I come back in a minute. So climate is a big theme in our bank. And in the green sphere, if you move to the next slide, the objective is to provide, so to speak, project finance of various types to a system-based approach where we promote the creation of bankable pipelines, where we deal with policy and regulation. So we can do project finance, we can do policy-based financing, we do sovereign, non-sovereign financing, we can do results-based financing. And these are our main groups of instruments. And in that, we can have blended finance support. We have other de-risking tools to make to be financially more versatile and flexible. And then, as I had mentioned before, we are collaborating closely with other MDBs and governments. For instance, we are the biggest co-financing partner of World Bank and ADB. And if you then look 2 slides further, because I understand this seminar is, or this is not just going to be about AIIB versus IADB, but we want to put things into the broader context. And here you see global climate finance. You see how that the trajectory is strongly upward. And on the left, you have climate mitigation. 1,800 billion, and adaptation finance 65. So adaptation is really the big gap in the financing world. That's at the same time where we also have the biggest problem of marketability, of, so to speak, creating global public goods with the help of the private sector. You know, in the mitigation side, that's renewable energy and transmission and so on. There, it's easier to price, it's easier to market, and many of the projects are actually profitable without government or MDB involvement at all. But in the adaptation area, this is much more much bigger challenge, because many things are difficult to turn into bankable projects. If you look at the next slide, I wanted to show you that as well. It shows you by country group how, so to speak, the climate financing is distributed across sectors. And you can see here that in advanced countries, transport, buildings, and infrastructure are almost of equal focus as energy, whereas then in China and the emerging and developing economies, energy is clearly has the biggest focus. And then in the less developed countries, agriculture, fishery, and other land use issues are much more important than in the other country groups. And water and wastewater also plays a significant additional role. So across country groups, the kind of the focus of climate financing is not equal. If you go another 2 slides further, then you'll see that there, even in the mitigation area, there is still big gaps. One always has to take these calculations with a grain of salt, but it shows that in China and Western Europe, we have maybe a gap of 50%. So actual mitigation flows are half what should happen. But in other country regions, this ratio is much less favorable. I don't know whether Avinash would agree to this ratio of 3 in Latin America and the Caribbean, but it's even less favorable in some of the other regions. And you also saw on the previous slide, maybe if you go one further, the important role of China. That China is so big that it's almost a category by itself. So I've also dug up some figures on China. And here you see the climate finance flows by sector for China. Energy and transport are huge and have grown hugely in the last 5 years. This is 2023, the latest figure we could find, so it's probably now higher now. And you can see in China how renewable energy in particular kind of are a kind of just a pervasive picture of also of the in the landscape. When you fly in over northern China to Beijing, you see kilometers and kilometers, thousands and thousands of windmills and photovoltaic for panel areas, kilometers for kilometers. Now, also China is for AIIB a moderately sized client. It was a bit bigger a few years ago, but now a bit less, partly because the local governments have financial difficulties, but partly also because we are only financing in China projects where really we have a value added and where we can gain value added and learn for projects than outside China. So innovative projects, data centers, smart cities, projects where we learn in China and then that way can scale and implement elsewhere. So, and of course, you know, a development bank also needs to do some financing in high-rated countries in order to be able to do financing in low-rated countries. So China is also for us, China financing. We have 7% China financing. It's also a way to kind of create a balance in our portfolio. I always say that we have this rule in our balance sheet that $1 in triple B can finance $1 in single B. You know, so to do a dollar in Nepal, you have to do a dollar in China or a dollar in India. Now the next slide shows goes to MDBs and the role of MDBs in climate finance. On the right hand is the high income economies. We should not forget that the EIB in particular, this is the heavily dominant part on the right, is very heavily involved in climate finance in advanced countries. Whereas on the left, you have the low and middle income economies, where you also see the AIIB as number 3 from the top with 5 billion in 2024, which is, I think, still less than the EBRD. And I'm just looking into American Development Bank. Where is it? Is it there? I don't know. Anyway, so the big guy in the game is the World Bank with 10 or 8 times as much as the AIB, and the Asian Development Bank more than 2 times as much. Now let's move on to the slide that says Climate Action Plan. We have a climate action plan, which is also on our website, to actually make sure that the commitment to over 50% financing is realized. So we have strong client focus with differentiated and tailor-made solutions, impact, adding value to projects. These are, of course, slogans, but we really have kind of in our projects, in our project documentation, adding value in the client countries, adding value for AIIB is always a major test for any project to go through. And then mobilizing financing partners, mobilizing concessional finance, blended finance, but also private sector is now part of our corporate scorecard. So in order to, so to speak, make true our commitment to private capital mobilization, this is also now become part of our corporate scorecard. And finally, innovative, we try to be innovative, especially through our technical solutions. The next slide shows how our climate financing is divided up. You saw before that for mitigation finance is roughly 20 times the size of adaptation finance. I'm not sure how reliable those numbers are, but you can see we are not so bad here with 27 adaptation and 73 mitigation, 1/4 non-sovereign, 3/4 sovereign. And then energy is, of course, the biggest component with roughly 1/3. And then what we have here as multi-sector is usually our financial intermediation finance through funds, through on-lending of banks, through equity, through debt, through various vehicles that we can apply. And the next slide gives more detail on the sectoral distribution and the distribution between climate mitigation and adaptation. I'm not, for the interest of time, let me just go to a couple of projects. If you go 2 slides further. Yeah, so this is Bangladesh Climate Resilient Inclusive Development Program was our first policy-based financing project. And we do policy-based financing in particular to improve the regulatory environment so that we get private investment in infrastructure, in green infrastructure, in renewables, etc. So we work a lot with the other MDBs in policy-based lending, but we see our niche or our go-to reason for improving the policy environment for private capital mobilization. And Bangladesh was our first case. In the meantime, we have done a couple of more. On the next slide, you see a project, a Chinese one, where this is kind of why this is a typical kind of one where, we have been involved in a project which doesn't just provide electric buses instead of diesel fleets, but it has financed the whole um, transmission or transition, digitalization of and AI-enabled traffic system. So the whole traffic management of this Liaoning is a province in northeastern China of the city. We have basically financed the whole public transportation traffic management system, not just the buses. Then we have also done in Singapore a transport connectivity project for the decarbonization of the shipping industry. That is the next one. Or then one where we have the multi-country Seraya SEA Energy Transition and DI Fund after Singapore. One more. This project, for instance, funds high growth tech enabled sectors. So it finances offshore wind farms, support vessels, electric vehicles, charging networks, autonomous vehicle leasing, and green data centers, all via a fund for Southeast Asia. So the good thing about the Asian space is it's big and there is a lot of dynamism. There is a lot going on. And when you go in there and you kind of have trust of the clients and trust of the governments, you can really do a lot. And I think maybe just as a concluding remark, the Iran, the Middle East crisis has reminded all of us that in a way, energy access should not be forgotten over decarbonization. But how do we turn this into an opportunity for climate? I think one channel is that energy security has to come to the foreground, and we have to make sure that renewables and energy systems that are safe and have good access are part of those strategies. And I think this would be also a question to Avinash, and maybe it's a good lead over how Inter-American Development Bank is starting to see this. Whether we have all been working with Paris alignment and national decarbonization strategies, but the risk is that we lose the countries, or the countries kind of lose interest unless we help them to say, look, decarbonization is part of your solution and not your problem. Maria, back to you. Thank you very much, everybody.
Thank you, Ludger, for the very interesting presentation. Avinash, the floor is yours. We are looking forward to hearing what you have to say. Thank you.
Thank you, Maria. Can you hear me okay?
We can hear you perfectly.
Great. Well, it's a real pleasure to be back at the E-Access Forum and to share a platform with Ludger and Maria. I'm going to focus a little bit on adaptation, but I want to take up the question that Ludger left with. We are in a challenging environment for those of us who wish to see further finance in the climate space. And I think that the world has changed over the past 10 years since Paris, and the arguments for doing what we're doing has changed. So 10 years ago, the time of the Paris Agreement was overshadowed by where things were a few years before that. And at that time, renewables were not the cheapest form of energy. And so to encourage investment in clean energy, we focused on creating plans, on subsidies, on concessionary finance, on support. It was a sort of directed strategy, and I'm talking about Paris and the policies around there, a directed strategy with financing. Since then, there have been huge technological changes. Thanks in part to the economies of scale that China has delivered, the costs of solar has fallen in 10 years by 90%. 90%. And today, an argument based on cost effectiveness, on efficiency, on remove subsidies and focus on efficiency will get you renewable energy for 90% of the countries. And if you were to add to that the issues of accessibility and the issue that Ludger mentioned at the end on security, I think that you find that those issues that matter tremendously to countries. And when a country when a country talks about energy, without talking about the planet, they will talk about affordability, accessibility, and security. And those are three reasons why a test as to what energy system you invest in will lead you to cleaner fuels, which will benefit the local environment and the international environment. And I think that's a very important change. So yes, we at the IADB focus today on country-led plans, on supporting countries move towards great affordability, accessibility, and security in their energy systems. And we're confident that's going to continue to lead to a clean energy system. Energy is not the challenge in Latin America and the Caribbean for emissions, partly because of a history of hydropower. Countries like Costa Rica and Paraguay are 100% renewable, not because of solar and wind, but because of hydropower. And so Latin America and the Caribbean actually has the cleanest energy of any continent in the world. That's the challenges in Latin America and the Caribbean are more around agriculture and transport, but not on electricity generation. Which isn't to say that we still need to, we mustn't still do more. And indeed, hydro has become, we think of hydro as renewable, sustainable, but because of climatic change, hydro has become less reliable than it used to be. So where the region was relying on almost 55% on hydro, that is now down to 40%, in part because of weather impacts. And so we need to continue to invest as energy demands grow in electricity generation. That is accessible, affordable, secure, and also supports the local environment, local health, and globally so as well. Let me talk a little bit about how we think about these issues in Latin America and the Caribbean. Lots of parallels with what Ludger was saying. And I want to offer a framework for thinking about how we are financing adaptation in particular and transition. I think that because the needs, and Ludger had a great slide there looking at the ratios between what is being done and the needs, and those ratios are huge. 3 times, 4 times, 5 times more needs to be done. Because of that, we have what I call magical solutions. We see ODA, overseas development assistance, bilateral aid, shrinking at a time as these gaps remain very large. And so people have been putting their hopes in magical solutions. Maybe tech will save us. Maybe insurance will save us. Maybe the private sector will save us. And I think that it's important that we're real about this. Tech, markets, the private sector, insurance have roles to play, but they're not going to save us. And we have all the tech we need. Climate is uninsurable. And markets can do a lot. The private sector can do a lot, but there's some things that markets cannot do. There's an important role, as Ludger mentioned, for the state, for the public sector in this space. But I do think that if we have the right framework, then the challenge is more than financeable. We can do this. We have the ability to do this today by breaking it down in different parts. So when I first arrived in the climate space, which was quite late compared to most people, it was the 2017 Atlantic hurricane season. I was flown in to help support a tiny island of Dominica recover from a Category 5 hurricane, Maria. The region had 2 Category 5 hurricanes in the space of 2 weeks, Maria and Irma. And as a result, people began thinking, this is a once in a 100-year event. Why are we having it over 2 weeks? And so people began being very focused on climate change, and I became quite focused on that. But when I arrived, people were talking about adaptation and mitigation and loss and damage. Indeed, for a long while, because when you arrive early in a subject, late in a subject, it's often too embarrassed to ask what the words mean. And people were saying there was this word people were using. It was adaptation mitigation, as if it was one word. And as a finance person, I began, struggling about this because I think these things are very different. Mitigation, adaptation, loss and damage. Yes, that's all related to climate change. We need loss and damage money because we've not adapted enough. We need mitigation. We need adaptation money because we've not mitigated enough. But these are 3 very different things, and you would finance them very differently. Indeed, a lot of mitigation, so reducing greenhouse gas emissions, makes money. Solar power, hydro, wind turbines, they generate revenues, they generate energy. So that is something in which we could engage the private sector. But a lot of adaptation doesn't. A lot of adaptation are public goods. And in economics, we have this term, public goods, and the clue is in the word. It's very hard to privately finance public goods because they are not their revenues on their revenues, their economic gains, but they're not capturable. Imagine the public park. There's so many people who benefit from the park being there. But if you start charging a fee, there are a lot of people who are benefiting from it who never have to go in it because they're outside, and you're not going to be able to finance through private fee structure. Think of a seawall. Imagine if you tried to say to people behind the seawall, well, you could pay or not pay. And if you don't pay, you can't benefit from the seawall, even though you live there. So these are not capturable revenues. So a lot of adaptation is not something the private sector can do. Only 3% of adaptation is being funded by the private sector today. I think that could rise to 6 or 10%, but the vast majority will have to be public sector funded. It's a key role for the government, for the state, in Ludger's framing. And then loss and damage is something for which there's no but the reason why adaptation needs to be funded and can be funded by the state is because adaptation funding generates huge fiscal savings. We found that resilient public infrastructure, $1 spent on resilient public infrastructure saves $10 in the future. That is something, therefore, you can borrow for. You could effectively pay back the money you have borrowed through the implicit savings you've made from that investment. So we might be able to get the private sector to do mitigation, and we can get governments to borrow to fast track their resilience and their adaptation. Leaving loss and damage, which is not something the private sector can do. When your low-income housing has been wiped away by a flood, the private sector has no revenues there to rebuild it for free. The state could rebuild it, but it will lead to more debt. If climate vulnerable countries use debt every time to deal with loss and damage, they would sink under oceans of debt long before sea levels rise up. And so that's where you need grant money. That's where you need bilateral aid. And the bilateral aid we have is shrinking, but it's enough if it was focused on loss and damage. The MDBs are expanding, and the MDBs are expanding their balance sheet, and they can't do everything, but they can do enough if they were focused on adaptation. They could own the adaptation space. And the private sector can't do everything, but they can do mitigation. And if they did mitigation, that would make a huge difference to the planet. So the way we think about this is to be a bit more finely tuned, is we divide up the world not in terms of adaptation, mitigation, and loss of damage, but in terms of revenues, savings, costs. Those things that generate a revenue, we need to get the private sector involved. Those things that generate few capturable revenues but lots of savings, MDBs, multilateral development banks, can lend to governments for those things. And those things that generate no revenues and no savings, that's where we want grant money, precious, rare grant money to be focused on things that can't be funded any other way. So if you're using grant money for mitigation that the private sector can do, that's a waste of grant money. If you're using grant money to do things that the MDBs can lend for, then that's a waste of this precious, scarce grant money. And so, of course, the world is not so neat, but revenues, savings, costs. Let the private sector do the revenue stuff, let the MDBs do the savings stuff, and let the bilateral aid donors do the cost stuff. Let me move on a little bit to how we actually do that. And before I do that, I want to pause a little bit to talk about why climate change is uninsurable. So when people think of disasters, people often think of insurance. All of us probably have house insurance, car insurance, and it makes perfect sense to do that because we insure ourselves against tail events. We insure ourselves against you writing off your car every 20 years. And so if you were to pay every year 1/20th of the cost of your car, it's a good savings plan. So when you do write off your car, you're not stuck with a bill impossible to pay. So something that people forget is that insurance is not magic. The payouts from insurers are in fact less than the pay-ins in terms of premiums. There's no leverage with insurance. So if you've got climate change happening, disasters increasing in size, increasing in frequency, premiums have to go up doubly, quadruply. Climate change can't be solved by insurance. And parametric insurance, where we limit the payout, does limit the premiums, but only because we've insured ourselves by less. We're seeing a lot of parametric insurance instruments proudly saying how quickly they paid out, but the amounts they paid out were not enough to deal with the disaster. So for those of you interested in statistics, one way of thinking about this is the distribution of risks. Insurance makes perfect sense for tail events. It doesn't make sense for you for you to spend money protecting your house against any possible event. It makes sense for you to insure your house against events that take place every month, every year, but to use insurance to use external insurance for things that happen every 20 years. And what's happened with climate change is these tail events have moved from the tail to the center of the distribution. What we need to do is invest in physical resilience that pushes those risks back to the tail, and then we can use insurance for that. So MDBs, with their expanded lending headroom It's because of the what's called the CAF reforms, the Capital Adequacy Framework reforms. The MDBs now have an expanded lending headroom by some $700 billion. $700 billion. In this world where people talk about billions and trillions at will, it's sometimes hard to picture that. But let me say, we've never had that increase of lending headroom by MDBs ever in our history. And $700 billion of additional lending headroom will go a long way if that was focused on adaptation and resilience, a long way to solving the adaptation and resilience problem. But how do we do that? In the most effective way? Because governments have and ultimately, we can't have lending, supply of lending without the demand. And governments have a tremendous set of demands that they have, and they don't always think of adaptation and resilience as the primary demand because they're struggling just to survive in some cases, and so. We have to recognize that climate vulnerable countries in particular tend to be heavily indebted. So the notion of taking out an additional MDB loan, even if we're low cost, to deal with resilience and adaptation is not always top of their agenda. And so there are a few things we can do. Firstly, we need to include climate vulnerability in thinking about concessionality and access to low-cost loans. At the moment, that eligibility tends to be focused on income per head, and it misses the fragility of climate vulnerable countries. In the case that I began talking about, Dominica, they had lost 226% of their GDP in 4 hours. That's a vulnerable country. And to say they're not eligible for concessionary money because on a typical year, their income per head is higher than the AIDA level of $2,000 per year less, doesn't make sense. So we need to change our eligibility criteria to include vulnerability. We need to use debt swaps. So we put our AAA guarantees onto a country's new issuance of debt, and so they can borrow at 4% rather than at 10 or 12%, and use the interest savings to invest in resilience. And we've started doing that in our region. We've done about half of all the market-based debt swaps, and we've created a multi-guarantor debt swap facility that allows us to do bigger debt swaps and more debt swaps by bringing in other people, other guarantors, and finding ways for which our guarantees can fit together. So expand concessionality, debt swaps. We also need to offer a different type of loan, I think. When countries are investing in resilience and adaptation, they're building a seawall to last 50 years. Why are we lending to them up 10 years or 15 years? So we may need to develop new instruments, new resilience loans that are extra long-term, and maybe have extra long-term. And then finally, we need to look at our fiscal frameworks. At the moment, our fiscal frameworks tend to focus on the level of debt a country has. And indeed, many countries are told that they've got too much debt, and that these fiscal frameworks stop them doing the fiscally prudent thing of investing in resilience that will save them money. That makes no sense. And that's because we add up debt as if all debt is the same. We need to come up with different weightings around debt. Debt that saves you money in the future should not count the same as debt that does not. We use risk weightings in the way we regulate banks. We may need to use sustainability weightings and savings weightings in the way we think about debt. So the final thing I would say about adaptation and MDB financing adaptation is that we need plans, because as Ludger mentioned, many of these issues are systemic issues. If I make all the bridges in a country resilient, but none of the roads, then that's not going to be very helpful. So we can't do resilience and adaptation in a one-off way. We need to do it as part of a system. We need to think about resilient transport systems, resilient health systems, resilient public infrastructure systems, road systems, etc. So we need country plans, and we need countries to invest in developing those country plans. So in summary, MDBs are perfectly positioned to support the financing of countries becoming more resilient in the framework of finance, with the private sector doing mitigation, with bilateral aid focused on loss and damage. I believe that a very strong role is for the multilateral development banks to lend long-term to countries to build resilience. The increased lending headroom with a focus will allow us to make a big difference to the adaptation needs of countries. But it's not just about money, it's also about instruments. We need to help indebted countries fast track their resilience through debt swaps, through concessionality around vulnerability, through long-term and new instruments and fiscal frameworks that reward countries for investing, for prudently investing in resilience. So I think that we have a role to play. We're playing that role. We have to continue playing that role and doubling up our efforts. And I think we can make a difference. Thank you very much indeed.
Thank you, Avinash, for the very interesting and lively presentation. I mean, you definitely feel very strongly about all of this. And thank you to both of you, because, I mean, probably you all know, but there is quite a big time difference between Washington and Beijing. Okay, since I'm the chair, I'm going to be, here using my privilege to ask you, just a few questions. I see that there are also interesting questions in the chat. I mean, some congratulating you, I mean, for the clarity of the presentation. But, since the IMF World Global Financial Stability Report has been issued recently, and the issue of emerging markets has focused, one of the chapters that is precisely dedicated to the non-bank financial institutions. I thought that it was only timely, and I mean, since we have the privilege to have you both here with an insight of, how these countries are being financed. I mean, as you know, there is a big concern that all this regulatory push after the great financial crisis has brought financing out of the banking system, particularly the more risky financing. And as a consequence, the sensitivity for market-based non-bank financing, particularly hedge funds and mutual funds, has increased considerably in emerging markets. Of course, I mean, when I was listening to the IMF presentation of the GFS report, it came to me, I mean, this question is, what is your concern? What is the concern that this sudden withdrawal of financing, from these non-bank financial institutions that now seem like more focused than in the past in emerging economies, that this could put at risk the financing of transition and adaptation. Avinash, maybe, that you are in Washington, closer to the IMF.
Well, I mean, I think that sometimes people forget that an important part of market-based financing for development is in the way multilateral development banks finance themselves. We issue bonds. With our AAA, the private investors buy them when they want to have AAA instruments. That's how we fund ourselves. We have commitments from governments to bail us out if we get into trouble, which gives us our AAA. But the money, the day-to-day money, is all market-based financing. The second thing I'd say is we've had specialized investors in emerging markets for quite some time. They are specialized. They are focused on special opportunities. They have a very high return threshold. There will always be a role for them. We work with many of those investors. I'm sure the other MDBs do as well. But I think that really they're not my target. If we want to mainstream investments in emerging markets, so remember we need to focus not on those specialized investors, not on hedge funds and private equity firms, but institutional investors. Here's the amazing number. Only 2% of institutional investor money is in emerging markets. I mean, that's weird. 2%. That's where 60% of all the growth is, and only 2% of their money is there. So there's something wrong. There's an institutional barriers, and we're working and hoping that Ludger and IDB, we will be partners on this project with our Reinvest Plus project, where we're hoping to deliver to institutional investors what they want, rated securities and hard currency, by packaging existing bank loans in for local banks in developing countries. They're performing loans, not their new, original, exciting loans, and finance their existing loans. And when we give the local banks the money from buying their existing loans, we ask them to reinvest. We require them to reinvest the new money in those sectors aligned to the National Development Plan. So we think there's a way to create a conduit for institutional investors to be flowing into emerging markets, and that's the money we need rather than the specialized investors.
Luca, what is your view about my concern as I raised in that question?
I think you're on mute, Ludger.
Yeah, you're mute.
Yeah, sorry about that. Now I'm also invisible, so corrected all that. The concern about adaptation finance lies clearly in the fact that only a very limited part of it can, so to speak, work without either, so to speak, direct public sector financing or at least some kind of financial support. There are new initiatives and new attempts to allow more of it, or to use the public money, as Avinash was saying, better. But it's the ultimate problem remains. We are going to have a workshop at AIIB next week, where we're going to look at, for instance, how we can use in biodiversity and nature projects, how we can better mobilize private sector financing. These are all typically, I mean, it's not pure adaptation, but in biodiversity, there's this kind of significant adaptation component. And at the same time, it is also true, as Avinash said, that so for that area, we can't really use the financial sector much at all. I mean, for the adaptation area, and even in the mitigation area, and in some other in the other infrastructure areas, we learn, as Avinash rightly said, only 2% of the money of institutional investors in emerging economies, and a lot of and despite consistently high returns in infrastructure, big reluctance. Partly there's a regulatory bias. I mean, I'm not so sure that how shall I phrase it cautiously enough? I don't think our regulatory system is really neutral. There is strong national and advanced country biases in our regulatory systems, which means that even kind of on average, relatively a high return projects, hedged in a way, naturally hedged to the number of projects, it's difficult sometimes to attract private money without sweetness. And often, you get the institutional investors only if you have somebody coming in taking first loss and so on. So in a way, I also hope that we can work together. Our two banks can work together on this Reinvest Plus. We have, when we first exchanged on this, we had very similar ideas. We found out we had kind of from different ends relatively similar ideas, but I think the IDB is you're just a much more experienced bank than us, so we have a lot to learn from you. But I think in this area we can also come in as a good partner. So kind of securitizing existing bank loans for new clean lending, I think that's really conceptually the way to go. And we have to make it work and overcome a lot of our internal inertias too. We're all dollar banks, or not all of us, but most of us are dollar banks. That creates an inertia by itself. It creates an inertia and a bias against local currency financing, which is another, so to speak, elephant in the room linked to indebtedness. And in many projects that are marketable, they're marketable, but the returns are local. So you indebt yourself in dollars with an MDB, or nowadays it's not just dollars, but typically hard currencies, and then you get local currency revenue. So how can we improve on that? Personally, I think that so to speak, on the investor side, involving the institutional investors, and on the investment, the project side, being able to do more local currency finance will be very, very big and important steps going forward. Now, but that, as Avinash was also saying, is mostly for the marketable part of decarbonization, for the mitigation part of decarbonization. I have to learn. Honestly, I learned a lot from your presentation. I have to learn more how we can move forward in the adaptation area. I think that the role of financial intermediaries, funds, banks doing on lending is super important. And the development impact of this is much bigger than typically thought. Project finance, you finance a project, it saves you so much carbon, You can calculate that clearly. You have a good cost-benefit analysis financially and environmentally. If you do financial intermediation, help financial market development, help product development, like in this idea of Avinash to securitize loans, you leverage a whole system. And then you cannot predict what new ways of financing emerges that creates benefits. That creates benefits for the private sector, independent of climate, but that also creates benefits in climate. And I find we are struggling in the AIIB with measuring the impact of our financial intermediation projects. And Maria, I'm not 100% sure I understood your question fully right, but to make the turnaround, I see financial intermediation very positive because of the system benefits. You just, by creating an environment in which you can finance much better and have more liquidity, you're also likely to be able to finance much better all kinds of climate projects, and maybe also help bridge the financing gap for adaptation in some areas, at least in some areas.
Okay, I would like to take here at least a question from the audience, which I think is very interesting, even if we are running out of time a little bit, but I'm sure we can do that at least for a few minutes. Now, I mean, just to clarify, Ludger, it's not so much. I mean, I share with you that private financing, to the extent that is risk capable. I mean, it has the capabilities to assess the risk properly, is most welcome, because provides liquidity that is very much needed to finance and definitely mitigation. And for example, in Europe, adaptation, I mean, private financing for adaptation is growing significantly. But also the fact that it's much more volatile. I mean, that, as compared to the traditional funding in these countries, like banking, I mean, just, investment funds or hedge funds are much more risk sensitive. And whether, this pulling out of the market suddenly this could have, a significant impact. But I mean, implicitly, both of you, came to the conclusion that you don't see this as an important risk, to the extent that they are still, financing either multilateral development banks or that type of, great investments. That's, at least has been a little bit of my conclusion. Now, let me take a question from the audience, which is addressed to Avinash. Is whether, in your experience or in you dealing with credit rating agencies, you have the sense that your proposal in terms of treating debt differently when it enhances resilience, particularly in countries that are most affected by acute physical risk, whether the rating agencies are engaged, or they have taken this this recommendation, or they are at least studying it.
Well, it's a good question. I don't think the rating agencies would be leaders in any change like this. I think the system of official finance needs to lead that, and hopefully the agencies will follow. The IMF and the World Bank are deep in the heart of the infrastructure around the notion of debt sustainability analysis. And I think we need to start there. They're doing a fair bit of work, it should be said, today, ongoing, on thinking about this. The challenge on what the rating agencies will say is that, well, debt is all debt in one sense, that it all has to be repaid. And so, not counting it fully when it still has to be repaid in full is a challenge for them. And it's not about it not having to be repaid. It's about how sustainable it is and how a debt investment in resilience is more sustainable because you've made your future more sustainable. So I feel that the rating agencies are going to be interested parties, but they can't lead that discussion. It probably has to be led by the IMF and the World Bank. I'm a typical economist. We always believe that the success is somewhere else. So it's with the IMF or with the World Bank as opposed to with me. And I think then, but we need a framework. We need a framework which balances the fact that debt has to be repaid, and too much debt is a problem, with the fact that investment in resilience has these amazing returns, and countries are being stopped from doing it because of a framework.
Okay, well, I see that in addition to the chat, there were other questions in the Q&A, but I think we have run out of time. I don't know whether you guys want to provide, some contact info in case of, somebody who want to address, particular questions that unfortunately we didn't have. But we were definitely most interested in listening to you. I only have to say thank you. Thank you, Ludger. Thank you, Avinash. This has been fantastic. I think we all have learned a lot. And of course, thank you to the e-Access Forum that has supported this seminar. I hope we'll have more of this. Maybe we'll talk about different things or with different formats. And of course, thank you to Anastasia Papas that is behind and has made all of this possible. Thank you all. Bye now. Bye-bye.
Thank you very much, Maria. Thanks, Avinash. Thanks to the audience. All the best.
Thank you.